and this is my submission for Dr. Crescent's Finance 31 2 p.m. class. Let's get the slice fixed right there. You might lose me, but at least you can see this project. Alright, so we're looking at 4 different companies. For this, we're trying to see who to give a short-term $100,000 loan to, who to give a long-term $500,000 loan to, and who we should be buying equity in. We're looking at 4 different companies. 2 we chose as a class, 2 we chose individually. The first one we chose as a class is Lamar. They were founded in 1902. They're based out of Baton Rouge. They have over 3,000 employees, and they're one of the largest outdoor advertising companies in North America. The next one we picked as a class is Medicis. They're also based out of Baton Rouge. They were founded in 1982. They have over 16,000 employees across the country, and they're one of the largest home health and hospice care providers in the U.S. The first company I chose is Stratasys. They are a 3D printing company. They manufacture 3D printers and 3D production systems. They have over 2,800 employees, and they're based out of Minnesota, founded in 1989. And the final company we're looking at is Tesla. They were founded in 2003 in Silicon Valley. They have over 30,000 employees, and they specialize in the automotive industry and battery charging equipment. They're making electric cars. So after we look at these businesses, we're going to look at who to give the short-term loan to. To do this, we're looking at 3 different ratios: the cash ratio, the current ratio, and the quick ratio. To determine, as looking at these 5-year trends, we can see across the board Stratasys is consistently higher than the other 3 companies. Because of this, I'm usually the most comfortable giving them the loan. They have the highest cash ratio, highest quick ratio, and highest current ratio. So I'm going to move on from this one and look at long-term solvency, who to give this long-term loan to. To account for this, we're looking at total debt ratio, equity multiplier, and times interest earned. I wasn't exactly able to set up a 5-year trend for times interest earned. The values of Tesla were so low in the first couple of years, it was hard to set up an accurate graph where everything just wasn't all jumbled together, so I just left this little chart of numbers. Looking at the total debt ratio, we see that Lamar has the highest total debt, followed by Tesla, then Medicis, and only 1 value for Stratasys. I also only had 1 value for Stratasys for times interest earned ratio. Because of this, I kind of crossed them out of giving the long-term loan to them because there's too much uncertainty, not enough values to back them up. But looking at these values, we can see that, what are we looking at? Tesla. Tesla right here is taking on the most debt, even though total debt ratio is showing Lamar has the highest total debt ratio. We're going to move on. All right. Well, looking at the times interest earned ratio, this is the ratio I really paid the most attention to. Looking at this, we can see that Lamar is consistently the only one in the positive. Across 5 years, their times interest earned ratio is increasing across the 5-year span. Because of this, because they're the only one able to pay their interest, they're able to pay back their loans and still stay afloat fine, and they are over a century old, I'm comfortable giving them my long-term loan. Yes, they have the most debt. Yes, the equity multiplier is higher than both Medicis and Stratasys, but as I said, I already cut Stratasys out. And Medicis has consistently stayed in the positive for times interest earned ratio. So I'm actually going to choose to give my long-term loan to Lamar. As I said, it's the only business that's able to meet its current obligations, and this is the big reason why I'm choosing them. The next thing we're looking at is buying equity in these companies, who we want to invest in. To do this, I set up ratios for profit margin, total asset turnover, and equity multiplier. We use these 3 ratios to determine the return on assets and return on equity. Equity multiplier we're using again because this is important at looking if the return on equity is actually driven by leverage, driven by debt, something you don't exactly normally want. So looking at profit margin, we can see that both Medicis and Lamar are consistently increasing across the 5 years, while Tesla increased significantly from a negative number to almost a positive and then has slowly started to drop back down. And Stratasys has gone from the positive and has taken a sharp drop to the negative. So we're actually going to stay away from Stratasys because of this. If we look at their equity multiplier, they're not really taking on any new debt. And total asset turnover is actually decreasing and kind of leveling out. It's starting to increase a little bit, but it's more leveled out. While we're looking at Messis, their total asset turnover is consistently higher than everyone else's. So that makes me comfortable in their asset efficiency. And we can look at their equity multiplier and see they're not really taking on any new debt either. And we're seeing an increase in profit margin, so that is a very good value. Seeing Lamar's, they kind of have a similar thing going on. They have a lower total asset turnover, lower asset efficiency, but they are slowly increasing. And we can see that their value for equity multiplier, the amount of debt they have, is actually decreasing. While it is relatively higher than Medicis, it's still doing well. So we're going to look over and see the return on assets and return on equity, and also the market to book ratio. Return on assets, similar as the last ratios we looked at, we can see that from the increased profit margin turnover, total asset turnover ratio, return on assets is increasing for both Lamar and Medicis, who has taken a huge jump out of the negative and is starting to level out in the positive. And same for return on equity for these two companies. While we're looking at Tesla and Stratasys, they're kind of jumping around and having to actually decline in it the last 2 years. For the market to book ratio, we're trying to see how the market values these companies effectively, and we can see that Tesla is by far the highest, but it has a return on equity and a negative at the same time. So this is something that kind of makes me a little uncomfortable, makes me think that they might have hit their max on shareholders' return on equity, and it might be decreasing. So I'm really not going to take this into account too much for Tesla, because I can see their return on equity has dropped, their return on assets has dropped, and they have, if we can pull back that last slide, they have also increased their equity multiplier, so they've taken on a lot more debt, and they still haven't been able to turn a profit. Right here. And so if we're going to jump back up, from these ratios, I've determined that I want to invest in Lamar. They've got the highest return on equity, the highest return on assets, and as I said, there's a steady increase in profit margin and total asset turnover. So I'm fairly comfortable investing in these guys. I'm also going to invest in our other company we picked as a class in Medicis. The 5-year trend shows that they are steadily increasing across the board. Their profit margin is still in the negative for this past year, but with the trends that we've seen from our return on assets, return on equity, the rest of everything that's going on with these guys, they seem to be doing quite well and should continue to do well in the next few years. As I said earlier, compared to Lamar, their return on equity is not driven by leverage, yet it's still increasing. So that is something I'm comfortable with in investing with these guys. Hopefully this was good enough for the project this time. Thank you guys.